Hello, everyone. I'm Andrew Schmertz. Many economists will tell you that if you want an indicator of the stability of the world's financial system, look at the bond market. And after you do, you may want to cover your eyes. There is a growing sell-off of government bonds across the world. And last week, U.S. Treasuries suffered their longest losing streak in 4 years. And with bond prices falling, their yields are going up. Is this a mere correction in the bond market, or is it telling us something much more? Coming up, we'll talk with Andrew Schiff from Euro Pacific Capital. But first, stocks held a mild sell-off on Monday. Let's take a look at the final numbers. Red across the board. The Dow down nearly 86 points. The S&P 500 off 0.5%. And the NASDAQ backing off about 10 points. Taking a look at commodities. Gold closing down and oil back again below $60 a barrel. And in other economic data out today, confidence among small business owners dropped significantly. According to a Wells Fargo Gallup survey, business optimism dropped from 71 to 64 in April. This was the first significant decrease since November of 2012. So what's going on with bonds? Andrew Schiff from Euro Pacific Capital helps us through the numbers. Andrew, good to see you. Welcome back to Arise Xchange as always. Okay, so all of a sudden, people's attention is back on the bond market. If you're not in bonds, maybe you weren't looking so closely. What is happening here? Is this a correction? Is it a bigger sell-off?
Well, we'll see if it's going to be a bigger sell-off. We've had a couple of these in the past year or so where bonds rally about 50 basis points. I think right now we're at the key resistance around 220, about 225 on the 10-year. Which is kind of the major rate. The
10-year Treasury.
10-year Treasury. If we can break through this and get up to 250, 275, that'll be a big, big event. Bonds haven't been up there for at least a year, and much higher than 3. They haven't been, oh God, since before they had cell phones. So we'll have to see about that. But the interesting thing about this past rally, which started in mid-April, we've gone up about 40 basis points since mid-April. The big thing is that the sell-off in bonds, which pushes up yields, has not happened against a rally in stocks. I mean, normally in Finance 101, it's supposed to be if stocks are rallying, people come out of bonds, pushes bond prices down, yields up, and they go into stocks. That's not happening. Today we had a 12 basis point back up into 10-year, and
the market went down.
And the market went down, and it's been doing that all month.
And that's because competition won for dollars, where you put your investment money in part reason.
Right. There's always the stocks and bonds are traditionally on the other side of the coin. You go to one or the other, but when both are selling off at the same time, which is what we're happening now, that's pretty significant. The last time we had a spike up in bond yields was at a time where we had a 5% increase in the stock market. So it's interesting.
What does this say, though? Is it telegraphing a bigger problem with the world's economy?
Well, I'd like to think so. I mean, I think, at our firm, it's like, wake up, everybody. I mean, we just come off a very bad first quarter. We had this jobs report last week, which people are painting as good. It's mediocre at best.
It was mixed.
Well, it's mixed in terms of the headline number, 223. But when you look at most of the job creation was in part-time jobs. That was the big number. Full-time jobs.
And still no wage inflation.
And no wage increases at all. The first quarter is probably going to come in negative. We had that 0.2%.
But that's because of the trade deficit and the dollar a little bit.
Well, still, but
it's still pretty anemic.
And the productivity numbers are really off, too. So we're probably going to get a negative print on the first quarter GDP annualized. Now, last year we had that as well, but we had this great rebound in April of last year. If you remember, April and May were fantastic. We had a 5% GDP annualized in second quarter. That's not going to happen this year. All the data recently are soft. So we're looking at a very slow growth first half. We probably don't get a huge bounce back in second half, which means all of these 2.5, 3% GDP forecasts are out the window. And that's what had driven the forecast for the bond market.
If the bond market keeps falling and interest rates keep coming up, then is it natural that all of the interest rates are going to follow? Meaning it becomes out of the control of the Fed.
Of course. Of course, the real estate market is totally based on interest rates. If they get much,
it's true. We've seen significant concerns over mortgage rates and sensitivity.
As is the stock market. I mean, this whole stock buyback boom, which is a big driver of stock prices, that's been financed by very low rates.
Sure.
So I think the Fed's going to watch it. Of course, they want to raise rates, but they don't want to see the long rates get out of control. And if they do, and they start pushing down asset prices in terms of stocks and real estate, they're going to have to step back in and try to control the fear and keep bond yields at an even keel, so asset prices don't really fall off. And that's when we think when the Fed delays their rate increases even further, then people are going to start understanding that these expectations about high rates in the United States are completely off base.
Of course, higher bond yields are good for some investors if you're holding the bonds.
Sure, if you're getting paid, if you're a saver and you're a creditor, yeah, it's good for you. But we don't have an economy that's been run.
No one's saving money anymore.
Right. No one's saving money. No one really cares about the interests of creditors and savers. We're a debt-fueled economy, so the interests of debtors are first and foremost.
And finally, about 30 seconds left. This is not a U.S.-centric problem. Bonds across the world, government bonds, have been selling off.
Right. I mean, because there is a glut of bonds. I mean, governments have been issuing debt like it's going out of style, and so there's plenty of supply. And other than the central bankers, and the ECB is buying, but I think maybe their QE expectations are a little bit softer as the economy in Europe's getting a little better. So other than central banks, there's no one else buying.
Andrew Schiff, thank you so much as always.
Thanks.
Good to see you.